One very interesting thing that is happening in this housing market right now that is just truly remarkable is just how quickly things are falling apart. And if we look at just where home prices were back in June of 2022, less than 6 months ago, guys, the median home price across the country was $391,000, okay? And then if we just fast forward to today, in December, now the median home price is at $354,000. And you might say, well, that's not a big deal. It's still very expensive where I live. Interest rates are more than double what they were a year ago. So even if I save on the home price, I'm still paying more per month. Well, that might be true. However, one thing you have to recognize is that decline from 391,000 down to 354,000 is a 10% decline in 6 months, guys. And as far as I know, we have never seen the housing market crash that much, that fast. And I know a lot of people are going to push back against this and say, that's not a housing market crash. Even if it goes down by 20%, it's still not a housing market crash. And I think people who believe that are just being completely unrealistic with the expectations of how this thing is supposed to play out. Because housing crashes don't work overnight, guys. This is not the stock market. You're not going to see home prices fall down 30 or 40% from one day to the next. It's not going to be like that. That's not how housing crashes work. They take years to play out. It's very long and slow and drawn out, okay? But what's happening this time is we saw home prices go up extremely fast over the past couple of years, anywhere between 30 and 40% in a lot of markets, but that took 2 years to go up that much, all right? And just think about this. It's only been 6 months and the median home price across the country is down 10% in 6 months, guys. Now, at that rate of change, think about this. That's 20% a year. So in a year from now, home prices will be down 30% if it stays on that trajectory, if it stays on that trend. 30% from the middle of 2022. And if you don't call that a housing crash, I don't know what is, because that's basically how much home prices fell nationwide during the last housing crash, and everyone was freaking out and the economy was in bad shape, people were in big trouble, and everyone looked at that as a housing crash. But this time around, you're not going to see that as a crash. Makes no sense to me. And here's another really interesting way to look at this as well. If this chart and the prices go down an additional 20% from where we're at now, that puts us at pre-pandemic home prices, guys. That's right. A lot of people thought, well, there's no way we're going to go back to pre-pandemic home prices. Well, at this current rate of change, that is a definite possibility in approximately 1 year from now. And here's the kicker with all of this. We're seeing these price declines and everything going down. At the same time, mortgage rates recently have been falling. That should help people get back in the market and buy, right? It makes housing more affordable. We're seeing these declines at the same time that a lot of sellers are taking their properties off the market and there's less home inventory available. And part of the reason why home prices went up was because of the supply and demand dynamic. And when supply goes down, typically prices go up. But yet we're still seeing prices fall. So if home prices have been going down in the last 6 months with these other factors in the market that are supposed to help prices remain high, what do you think is going to happen when next year comes and mortgage interest rates go even higher than they are now? Because the Fed's not finished with the interest rate hike. So mortgage rates a few months from now, they're going to be higher than they are today. What do you think is going to happen when the spring avalanche of a ton of new listings comes back to the market from all the people who've been removing the listings now, thinking that somehow they're going to do better when the spring comes? And what about all the foreclosures and short sales that will be showing up? People who are underwater on their mortgages listing their homes for sale because they need to do a short sale now that their home's worth less than they paid for it a year ago and they don't have a job, so they have to do a short sale. What about all the new construction homes coming to market, guys? Do you see where I'm going with this? Do you see how the inventory is going to completely explode next year? And if we're already seeing home prices fall 10% in a span of 6 months, I think it is extremely and highly likely that we're going to see an additional 20% nationwide decline next year. Now, does that mean it's going to happen everywhere? No. A big fat no. But that is the median across the entire country, but real estate is highly local. I'm not going to dispute that at all. But you have to be careful and you have to pay attention to your market, because Lawrence Yun, who is the chief economist at the National Association of Realtors, of course, he's super bullish on the housing market, just like Jason Oppenheimer and Dave Ramsey and all these guys that have a huge interest in keeping things propped up as much as possible. Here's what he says is going to happen next year. He says that half the country may see small price gains while the other half may see small price declines. And then he said there's outliers and exceptions, like cities like San Francisco, where they might see prices drop 10 to 15%. Hello, Earth to Lawrence Yun. Home prices in San Francisco have already fallen more than 10%, and it's not even 2023. This is the dangerous thing, guys. You cannot just read news headlines and listen to these experts and take everything that they're saying at face value, because half of it's just flat out not true. If he thinks that, oh, next year certain markets like San Francisco are going to see home price declines by 10%, newsflash, that's already happened, guys. So where do you think San Francisco is going to be in a year from now? And in this same article that Lawrence is saying that pretty much everything's going to remain flat next year, they have a list of some cities that he thinks that home prices are actually going to go up in next year. So let's look at some of these places on Lawrence's list. Let's check out Dallas, Fort Worth, okay? That's a big one. That area's been growing like crazy during the pandemic, all right? So back then, they actually had their peak in home prices in May of 2022 of $490,000. But now the median home price in Dallas, Fort Worth is down to $402,000, guys. That is an $88,000 decrease in median home values in 6 months. That equates to an 18% drop. But yet, Lawrence thinks that this market is going to do very well into 2023. Hello, guys. Wake up. Look at this data. This is free. Anyone can go online and see this for themselves right now. You don't even need me. You can go and look at it for yourself. Go to Redfin, punch in your city or your market, and take a look. Is my market following this median home price decline trend line right now? Because Dallas is more than following it, they're beating it. Okay? Another one on his list that he thinks is going to do well in 2023, Huntsville, Alabama. Okay? This place at its peak was at $339,000 for their home values, and now they're down $319,000. So that's $20,000 less. Not as severe of a drop, but they're down 5.8%. So when you look at places like Huntsville and it's not as bad as the national trend line, then that might actually be good news for the local market, in the sense that maybe the fundamentals here are strong enough where, yes, we're going to see home price declines, but it's not going to be a Phoenix or Dallas situation where we're going to be seeing 40-50% price drops. And another one on Lawrence's list is Jacksonville, Florida. And back in the peak of June, Jacksonville home prices were at $320K. And fast forward to today, the home prices in Jacksonville are at $289K median price. So that's a 9.6% decrease in the last 6 months, guys, which is really right on target with the national trend line of this housing crash. So it's reasonable to say that Jacksonville is going to basically follow what these median numbers will do, most likely. But you know, I checked the same data for Miami. Of course, I'm here. I'm always walking the neighborhoods here. I live here. And if you notice, Miami has remained relatively flat. From the peak that we saw in June, home prices have remained relatively flat. It took a small dip over the fall and is now sitting roughly where it was 6 months ago. So places like Miami may not see a huge housing crash. And trust me, I wish it did, because the values here completely don't make any sense anymore, guys. But the way that the data's looking is, it looks like a housing crash scenario for Miami is not too likely as of right now. Of course, that can change, and if the data reflects that, I'll be sure to tell you guys. But the idea behind some of these markets supposedly that are supposed to do well is that the dynamics here still make sense in the form of they have better housing affordability, there are a greater number of renters who can afford to buy the median price home, there's strong job growth, there's also more jobs coming in the information and technology sectors, as well as positive inflow of migration. So they're looking at all these things as saying that these are the reasons that these cities are going to go up. But yet, if we check some of them out, then a lot of them are not going up at all. But there was one city on the list, Raleigh, North Carolina, that took a dip, 435,000 down to 395,000, but then have recently bumped back up to 412,000. So they're kind of in a similar boat like Miami. They took an initial dip as interest rates started going through the roof, but it's now sort of stabilized. And it's those markets that I would be looking at that I think will probably do pretty well during the housing crash, when the rest of them that are already down anywhere between 10 and 20% are going to continue falling pretty hard during this crash. Now, since we've been covering all the dynamics of this real-time housing crash, one thing we haven't even talked about yet in this video is the role that investors are going to play in this. If you go back just a year ago, investing in real estate was still a very good bargain for a lot of real estate investors with the ultra low interest rates. A lot of investors are just like home buyers and they won't pay cash for a property, they get financing. But one thing a lot of people don't realize is that the financing to buy an investment property is always more expensive than for your average home buyer. So if your average home buyer right now is getting rates in the 6 to 7%, then interest rates for investors right now are over 9% in many cases, guys, which completely erases any potential profit that you might end up wanting to get on your investment property, because most investors are going to be looking for an 8 to 10% minimum return on investment, but when you have a mortgage interest rate that's 9%, that pretty much erases most of that profit and is going to completely disincentivize investors from investing in real estate. And these rates are not probably going to go down anytime soon. So a lot of people think that these investors are just going to rush in and buy everything once prices start coming down, but it's not going to be that simple. Even for the big institutional investors, they only have so much money in actual cash, and a lot of their cash is not really cash like we've talked about before. That money is borrowed just like everybody else that borrows money, and the rates for borrowing that money are more expensive now. And you're starting to see now a lot of people that jumped into the landlord game during this run-up in housing prices are starting to regret their decision. In fact, there was a story of this woman in North Carolina. She had her home value go up about 40%. Okay, guys, just like a lot of other people saw happen during this run-up. She thought it was going to be a good idea to take a home equity line of credit out on her property and buy an investment property. I'm going to be a savvy investor, use the equity I have in my existing home to buy another one as an investment. Right on the surface, sounds like a smart idea, right? Well, except home equity lines of credit don't have fixed interest rates. Last month, the rate on her HELOC loan was 6.49%. And now it recently just jumped to 7.24%. Since the rate hikes are not over yet from the Fed, that number is going to go even higher into 2023. And what once was a profitable investment property for her is now going to be a negative cash flow property, which is basically a real estate investor's worst nightmare. And she came out and said that now I'm not going to be able to collect enough in rent to cover the interest payment on this property, and that having a HELOC to buy this investment property was probably a very big mistake. So what do you think investors like her are going to be doing pretty soon? Probably going to be looking to unload properties like that, right? Nobody wants to hang on to a property that's losing money every month, and if I have to sell it at a loss just to get rid of it to minimize further losses, then that's probably going to be a good idea. So when you look at all of these factors that are coming together to a head right now, all at the same time, This basically has housing crash written all over it. And I have no problem saying this over and over again because it's true, okay? I'm not out here spewing lies. I'm not giving you false information. This is public data that anyone can go look up for themselves. And if you have half a brain, you can pretty much put 2 and 2 together and realize, yeah, things are going down. And forget about the rising interest rates for a moment. What about properties that used to be profitable but no longer will be because of rising insurance costs, because of rising maintenance costs, because of higher repair costs, all of these things that now cost a lot more than they did just a year or 2 ago. And that's like when I was telling you guys the other day that I'd be very skeptical on buying an investment property right now because the expenses are so much of an unknown, guys. There are property taxes, there is homeowners insurance, there is HOA dues, there are repair costs that are all completely unknown right now of where those might go into next year. So until you can see some solid figures on the property, like, yeah, this is what my real property taxes are going to be for 2023, this is what the insurance bill is really going to cost, and all these things, you got to be very careful with investing in real estate right now because those things can completely make or break a deal. What, are you locked out? Are you locked out of your home? What? You want to say hello? I guess so, huh? I guess so. What's the matter, kitty? What's the matter? What's the matter? What are you looking for? You can't get in your house? I'm sorry, but I can't let you in. You're gonna have to wait for your parents to come home. I'm sorry, buddy. I'm gonna have to leave you here. There was a recent survey done from landlords, and they asked landlords about their expenses on their properties. And 80% of landlords reported increased expenses over the past 12 months on their investment properties. And 41% of the landlords said that their expenses on their properties have risen 10% or more. So that is huge for a landlord, guys, especially if you're operating on thin margins like a lot of landlords are. If you have an 8% return on investment on your property and expenses go up by 10%, now you're losing 2% instead of gaining 8%. Don't you see how that math works out? And then a lot of people will say, oh, you can just raise the rent because the expenses have gone up. Well, yeah, you can raise the rent, but only so much, guys. First of all, I had somebody also ask me this on Messenger the other day. Somebody wrote me a message asking, well, can I just raise the rent by the amount of inflation? Well, not really. It's not that simple. Why? Because if the price of the rental does not match the area, you can't just ask $500 more than the surrounding rentals because inflation is up, guys. That's the tricky part about being a real estate investor. I had an old real estate client literally call me before I started shooting this video saying, Michael, my maintenance fee on my condo is going up 30% next year, and she has this place rented to the same tenants for the past few years now, and she wants to know, what do I do? Well, there's nothing you can do. You have to absorb the cost. She's already saying, oh, I need to raise the rent next year because my expenses are up. Well, yeah, go ahead, you can raise the rent, but if no one's there to pay the rent, that's not really going to help you that much. And people have already been getting increases so much on the rent that a lot of people are not going to be able to afford further increases. So just thinking you're going to be able to raise the rent every time somebody has a bigger expense, it's not that simple. So if you ask me, what this all boils down to is, number one, a lot of people really are not cut out to be landlords because a lot of people have the mentality that I'm just going to raise the rent every time I have more expenses, but it's not that simple, because if the local market conditions do not allow you to raise the rent, then you won't be able to. So that's the first thing. You really have to know your market and know what the going rents are in your area. And if you think you're going to be able to raise it more than that and still get a tenant, good luck with that. And another thing I think a lot of people don't realize about being a landlord is you're starting a business, guys. This is almost equivalent to opening up a storefront and, you know, selling merchandise and starting a full-fledged business. Now, it's not the same type of business. You're in the business of providing housing now. And along with it comes business expenses and business responsibilities. And just like the majority of people in the world are employees, they're not business owners, is the same exact reason why a lot of people are not cut out to be landlords. They just don't have the grit and the willpower that it takes to be a successful landlord and not price gouge your tenants, and to really find profitable investment properties and not just buy the first thing you see. And I'm not saying this to be mean, I'm just saying that most people choose to be employees in their daily work lives. And if you have the employee mentality, it's probably not a good idea to become a landlord, because it's more like running a business than being an employee. So you need to be ready to run that business. But if you are a landlord, I wouldn't be surprised if you start seeing this right now, and that is more tenants starting to pay you with a credit card. And you might say, well, Michael, I'm a landlord, I don't accept credit cards. Well, you don't have to, guys, because there is a company out there called Bilt, B-I-L-T, and they will help tenants pay their rent with their credit card. So what they'll do is they'll charge your credit card for the rent, plus a 3% processing fee, of course, because they're not going to be the ones paying the credit card fee, and then they will go ahead and write a check to the landlord. And so tenants now are looking at using services like this more than ever, now that people are basically broke, guys. And when I hear stories like this about people starting to resort to credit cards, and there's companies now that will actually do this for you to help you pay the rent, that's the beginning of the end, guys. And that's only gonna last for so long, because once people who are broke have maxed out their credit cards, they're not going to be able to do this no more, and they're not going to be able to pay the rent. Next thing you know, evictions are happening all over the place. And I know people are going to say, well, maybe they're just doing it for the credit card points or whatever, and they can just take advantage and spend it on the credit card, which I get, guys. I do that too, but I don't know of any credit card that pays 3% cash back on the rent. Some of them do for certain things like going to restaurants or the gas station or whatever. But last time I checked, paying the rent wasn't on the 3% cash back list. So there's a high probability that most people who are doing this charge the rent on the credit card thing are not doing it for the credit card points. And there's so much more to cover, but I'll let you guys digest all of that for now. And if you enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I put out a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.